Bear markets. It's something we haven't seen in US stocks in roughly a decade. Depending on how you look at it, they can either be a major pain triggering panic, or, for those with a strong stomach, lucrative buying opportunities. Either way, investors are on the hunt for the next bear. You'll spot one when the market drops 20% or more from its peak. Predicting the next one can be really tough, even for professionals. But there are some key charts that top investors have found helpful at predicting bear markets in the past. So let's take a look at how some of these fared before the last two bear markets. First up, the yield curve. When the gap between long-term and short-term government bond yields is climbing like this, it generally means investors think the economy is healthy and growth will be stronger in the future. But when it starts to shrink and goes negative like this, that's when you might want to watch out. This is the dreaded inverted yield curve, and it usually means investors are really scared about the future of the economy. In 2006-2007, it inverted as the Fed lifted rates to try to cool the housing market. A bear market followed, as well as the worst financial crisis since the Great Depression. Since 2014, the yield curve has been flattening, bringing us once again pretty close to an inverted curve. So is it an ominous sign? No one's really sure. There's a heated debate. Some analysts say that years of never-before-tried monetary policies, like negative interest rates in the Eurozone and Japan, have distorted long-term rates, blurring the picture. Here's an indicator about investor sentiment. Zoomed out like this, it kind of looks like an electrocardiogram. But here's what you need to know. When the chart's really high, investors are feeling optimistic. And when it's really low, they're feeling pretty bearish. Let's have a look at January 2000, the highest point ever recorded on this survey. The World Wide Web was all the rage. The NASDAQ was going vertical, and investors would buy pretty much anything with .com in its name. I think we all know how that one turned out. Bear. This chart is not always predictive, but keep an eye on the extremes. When investors get really, really bullish, it can sometimes be a sign that their expectations are just too high, and there's not a lot of cash left on the sidelines to cushion any blows. On the flip side, really low levels of optimism actually have the most predictive power. Let's take a look at March 2009. Sentiment on the survey was at its lowest in years just before the bear market ended. If you bought the market right at its bottom, you'd be sitting on a roughly 300% return today. Another sign of excess? Deal activity. Companies snapping up other companies. Just before the dot-com bubble burst in 2000, you had a flurry of merger activity, including Time Warner's deal with AOL. Just before the financial crisis recession and bear market, deal activity spiked again. RBS's deal to buy ABN AMRO, the biggest bank merger ever, marked the top. So why do mergers matter? They can signal that companies have gotten excessively optimistic, or that they actually think deals are the only way to grow as the economy slows down. Lastly, jobless claims. Major bear markets usually, but don't always, coincide with recessions. Here, in both 2000 and 2007, jobless claims start to climb right at the beginning of what turned out to be major bear markets. A steady rise in claims can signal that something is starting to go wrong with the labor market. When the job market slows, consumers tend to spend less, hitting profits. Of course, none of these charts on their own can really give you a concrete answer as to when the next bear is going to emerge. But taken together, they can give you a pretty useful indicator about the health of the market. So when do you think the next bear market is due? Take our poll on WSJ.com or tweet me at GoldRiva.